Hey everybody, Alpha Investment Group. In today's video, I'm going to talk about options investing, and in this one, I'm going to talk about selling call options. I made a video previously about buying call options and buying put options. Well, in this video, I'm going to talk about the guys on the other side of the bet who are selling these options. So when you are selling a call option, you are positioning yourself at the other end of the bet. This is what people call a zero-sum game, in that the gains you experience are exactly equal to the losses the buyer experiences, and the reverse is true as well. The winner gets it all and the loser gets nothing, like a gamble at a casino. When you're engaging in a sell of a call option, you are essentially at completely opposite beliefs of what you think will happen in the movement of a stock, security, or in the general market. Now, just as a reminder, the buyer of a call option is looking for a high price movement upwards for a stock or security. He or she is engaged in this call option simply to lock in a contract where he or she may buy it at today's market price, so that when it does go up in the future, based off his or her analysis and belief, he can buy it at the contract's predetermined price and resell it into the market and profit off that difference. So if a stock is $10 and he buys an option for $10 and he believes it's going to go up to $20, when it does go up to $20, he can buy it at the predetermined option price and sell it in the market and profit off that $10 difference. So the seller of the call option is exactly at opposite beliefs. He or she believes that the stock price is actually not going to move up that much, and therefore it is his or her incentive to engage in the sell side of a call option. What kind of money does a call option seller make? Well, he or she receives the premiums for engaging the option. As I mentioned in the previous video, when you buy an option, these things are not free, and there has to be a cost associated with engaging in them. You pay a premium for engaging in these options, and the premium varies based off how high you want the price to be, how long you want the date to be, and based on how volatile the stock is. That premium that you pay based on these three variables goes to the seller of the option. So as I mentioned in my previous video, Amazon stock sells at $1,160 and some change. The premium for engaging in a $1,400 call option is about $50 a share, and it lasts for about a year. So the buyer of the call option believes that in 1 year's time, Amazon stock price will exceed $1,400. And because of this belief, he wants to lock in a contract to sell at $1,400 in a year's time, and that costs $50 a share to do so. The person on the sell side of this option believes the exact opposite. He or she may believe the stock price of Amazon will go up. The key thing is the strike price. He or she does not believe that the market price will exceed the strike price, which is $1,400. And what happens if it doesn't? Well, this is a very good thing for the seller. He or she holds the sell part of this option and it won't be exercised, but they will still receive the premium. Whatever happens in a contract for an option, the seller always receives the premium. So selling options is a very attractive way to make income off stocks that you believe will not go up past a certain price. Obviously, you should do a lot of analysis, and you should probably be well educated on these topics before you engage in them. And when and if you are, I would recommend selling call options. What you have to understand about call options is they are really only exercised once the market price goes up above the strike price. Why? Well, let's go back to the Amazon example. If I buy a call option and the strike price is $1,400, if it doesn't reach that, there is no attraction for me to exercise this option. That option essentially tells me I can buy Amazon at $1,400. But if it doesn't get there, that means it's cheaper and it's lower than that in the market. Why wouldn't I just go buy that in the market? The only attraction for exercising a call option is when the market price exceeds the strike price. This is when your option is considered in the money and has intrinsic value, because you can buy it through the rights of this option, which is cheaper than what it actually is selling at the market. You almost get an immediate discount essentially. This is important to consider because as the seller of the option, the only thing you care about is the market price and the strike price. And as long as the market price is less than the strike price, no one's going to exercise that option. And therefore, you can collect your premium without having to do anything else. Most of the time, options sell in bundles of 100 shares. So one contract on an option is considered 100 shares. If we go back to the Amazon example, if you're selling an option with the exact details that I mentioned earlier, you will make $50 a share on 100 shares. So you will make $5,000 right off the bat from selling this option. Seems like a pretty attractive idea, right? Well, you can basically engage in two different types of selling of call options. You can engage in the covered call or the naked call. The selling of a naked call option is when you sell an option for shares you do not own. Now, this can be extremely risky. because if the option is exercised from the buyer on the other side and you do not own these shares, you have to provide these shares, which means you have to buy these options at the market price and then give them to the options buyer at the predetermined contract price. Now, the only reason the person on the buyer side is exercising this is because the market price exceeds the contract price. So essentially, you have to buy the stock at a more expensive price and sell it at a cheaper price immediately to the buyer. You lose off the exact same difference that this person profits off of. So I really do not recommend selling call options that are naked. If you are wrong even by the slightest of margins, you could be losing potentially a lot of money.
To which your reaction will probably be something like this.
Like that Amazon example again. Imagine the stock went above $1,400. Let's say it moved to $1,450. And let's ignore the premium for a second. If the stock moved to $1,450, you would have to buy 100 shares at $1,450, which is $145,000. You would then have to sell those shares at the strike price of $1,400, which is $140,000. So you would be receiving $140,000 and you'd be buying for $145,000. Essentially, your net loss would be $5,000. You would have to subtract the premium in which you receive the money in, but this is just for example's sake. So if there is ever a big price movement, let's say a stock doubles or triples within the time of the options contract, you would be losing a lot of money due to the buyer exercising. Now, a covered call option, unlike the naked call, is a transaction where you already own the shares before you write the option. Now, when you already own the shares, you bought them at a whatever price in the past. You no longer have to buy the options as long as you have the right amount when the buyer of the option exercises his price, if they do so. You essentially just give up the shares that you already own, and that's the end of it. So a covered call option can be a very attractive strategy, and it's something I actually engage in, where if you believe a stock has stabilized, you can make extra money via the premiums just for selling options. Worst case scenario, you sell the stocks you already own. What you want to do with a covered call option when you're selling them is you want to put the strike price or exercise price well above the price that you bought them at. So if they do get exercised, you are still profitable because you bought them at a lower price. The option price at which the buyer of the option exercises at is still well above your personal market price buy. It may not be as high as the new market price, which is why the buyer is engaging in them, but it's a bet worth taking because you're almost riskless. You already own the stock, you receive income for selling these options, and if the stock doesn't move up, well, you received extra income. And if it does move up, the contract is exercised, you sell those shares, you still made the premium, and you would sell it at a price well above when you bought it. It's almost like a double income producing strategy. And one thing you have to take into account is the premium is paid no matter what. That's paid up front. You don't have to worry about the price of the stock in regards to the premium. The premium that the buyer gives and the seller receives is predetermined. When you buy that option, the premium is yours right away. So to quickly summarize for you guys, when you're selling a call option, you as the seller are enticed to do so because you receive income or a premium for selling this option. The seller of the call option believes that the stock price has reached some stabilization, or he believes it may go up, but it may not go up to the degree at which the option's details entitle. So you may very well believe that the stock price moves a little bit upwards, but it won't move up to the strike price or the exercise price in the contract that you set. And there are two different types of selling of call options. There's the covered call and there's a naked call. Now, whether you are covered or naked doesn't matter with the details of the option. And the person on the buy side doesn't care, and it doesn't affect him whether you are naked or covered. It only affects you if you are a naked call option seller because you'll have to provide those shares if the option is exercised, whereas a covered call writer or seller already owns those shares. And these are just some brief points I wanted to go over so you guys could have a better understanding of both the call and the buy side of options. Now that you understand where both are, you can learn more about both and engage in both sides if you want to. Or you can find a preference for one side and engage in that. Personally, I like to sell covered call options. I find that as an attractive strategy for my investment portfolio. And that's all I wanted to talk about, guys. If you have any feedback, please let me know. If you have any questions, don't hesitate to ask. Give me a like and subscribe if you like what you hear, and I hope you guys have a nice day. Take care.